Mindset rule number one. At a bank, a trader's stop is not a personal prediction failure. It's a risk transfer point, the level where they hand off exposure to another player, often another desk or a liquidity provider. Your stop just got hunted again. You placed it 60 pips above your entry using the safe 2% ATR calculation. Exactly what every trading book tells you to do. And you got stopped out right before the market turned in your favor. Now, here's what nobody's telling you. You're placing your stops exactly where the banks are looking to fill their orders. After 30 years trading for international banks in New York, I'm going to show you why your technical stops fail and a couple of rules that can keep you in the game through every type of market condition. I'm Tom Alonji, and this is part one of institutional stop loss placement. Now, I spent 3 decades managing hundreds of millions of dollars of FX risk every single day. And here's my bio. The difference between retail traders and bank traders isn't just capital. It's the way that we were trained. We were very fortunate, okay? We learned hands-on, surrounded by dealers who corrected us in real time. Retail traders, they don't get that luxury. They got to learn through their own mistakes and through books. I'm here to cut that learning curve down for you. Now, by the end of this video, you'll understand the first two rules banks use and a tiny simple adjustment that you can make very easily that can help you out with your stop loss placement. In part two, okay, I'll show you the adjustment rule that changes really everything. But first, let's get into structure and liquidity. And let's take you over the trade that just happened. Rule number one is actually a structure-based placement with a filter. Now, what happens, most retail traders, they place their stops using percentages, ATR multiples, or arbitrary pips amounts. Like, I'm going to risk 50 pips on this trade. And that's not really trading. That's basically gambling with like one extra step. Now, banks place their stops based on price structure. Swing highs, swing lows with a filter. Because an institutional stop is a zone, it's not a line in the sand. Smart desks define zones of invalidation, not single price points. And I'm going to show you exactly what I mean. All right, so basically, here's the trade setup and what happened to you. Sure, it happens many, many times. You have a structural low right here. The marketplace came up, reversed up to 118.10. It came down. You broke the structural low. You go short. That's a valid trade. Very, very good trade. But where you make your mistake is that you place your stop up at the structural top high. Okay, so you went short the euro dollar, let's say at like 117.60. Okay, where's the structural invalidation point? According to your book, it's the recent high right here at 118.10. Okay, and if the price returns there, what does the book tell you to do? It basically tells you that your trade is invalid. It's wrong. So your stop should be there, and you should basically stop the trade. Okay, so you got short at 117.50, stop loss 118.10. This 60 pips is really where the retail traders make their fatal mistake. I'm going to show you how you could fix this in one moment. Now, when you place your stop right at the structural level of 118.10, okay, and you get stopped out before the move continues. Why? Because banks know exactly where retail is actually putting their stops. They know where funds are putting their stops. They know where corporate flow stops are sitting. They can see it through the order book, and they understand exactly where those resting orders are. Now, because of that, they place their own protective stops just beyond those liquidity pools, not inside them. Now, if you look at your 118, what do you see? All the textbooks tell you what? It's a round number, a previous swing high, a level every retail trader is watching. Now, this is also a liquidity zone where thousands of stop losses are clustered, and banks know this. So when a bank needs to fill a large sell order, what do you think they look? Where do they go? They go above obvious support levels where retail stops are sitting. They push the price to the 118.10. They trigger all those stops, creating instant buy orders so they can sell into them. And then the market reverses and goes in the original direction that the retail trader actually really comfortably predicted. So here's what banks do. And this is basically the trick that I want you to really understand. When we make this structural low and the market reverses up and it starts to threaten the structural low, I want you to do one thing, and I'm going to actually highlight this for you. When this market comes down and you actually execute your trade, I want you to go back up to where the structural top was made. And you could pick one or two of these bars. I'm going to use just this really tiny bar right there. Candle, bar, it makes no difference. What I want you to do is I want you to take the difference between the top and the bottom of the bar or candle, and I want you to add it to the top. So right now, this top was 118.08. The bottom was 117.98. That's 10 points. You add 10 points to the top of the bar at 118.08. It throws you up at 118, like 20, 18, something like that. And then I want you to add a 5 pip buffer on it. So you basically come up to a stop at, like, say, 118.25. Now you got to account for that in your stop loss calculation because you're actually raising it up above. But let me mark the chart for you so you can actually see. So when you do that, you can actually see that your stop gets moved up from where the liquidity grab is to up here. The 118, say 25 level gives you plenty of room to actually hold and then watch the market actually trade in your favor. So when you're doing that, the structure tells you where to look. But then when you do liquidity analysis, it tells you how far beyond the structure you need to go. And it's a very simple calculation. You could use this little bar right here, or actually you can get more aggressive and use this deeper bar. They're both up at the structural top. Now, let me take you through this sterling dollar trade that I did. Okay, we had consolidation between 135.25 and like 133.34. We had a liquidity sweep that came down right here. So I actually got long down in this area. Now, what did I do? Now, I'm going to break it down for you to show you exactly how to handle something like this. No, I got long at 133.50. So what I did was I took the range of this low bar right here. So I took the top of 133.47 against the bottom of 133.28. I subtracted that difference. I came to a stop point at 133, the figure. So basically I risked 50 points to ride the market back up to right here. Target, high bars close. Right there was my target profit. I didn't get exactly all of that. I got some of it out at that price, and I just sold some out at like 135, like 27. Really good risk to reward ratio. So price never touched the 130 down here, gave me safe room. Okay. And also it gave me the ability to ride the trade, the trade up towards the target area and get out. So the buffer actually saved this trade. This is what I want you to start to look at. All right. So now that you start to understand structure and liquidity, the two rules that keep your stops out of the hunting zone, what I'm going to do in part two, I'm going to be revealing a time-based adjustment rule that basically is going to help you move forward with the marketplace into a consistent, profitable way of trading, a really good mindset. So that's how I trail stops, and I'm going to be introducing that to you in part two. I've also built a free stop loss calculator for you. The link is in the description. No email or nothing. You can go grab yourself that calculator, and I look forward to see you in part two, institutional stops revealed. Cheers.